I'm Keith McCullough, and welcome to The Pitch, one of my favorite new formats that we have here on the team, where we go around the horn, 6 analysts, 6 ideas in 60 minutes. So I'm not going to waste any more airtime. I'm going to go right to our leadoff hitter, who's had one hell of a year so far, Brian. I hope it's good.
It is. It's a young year, still a long way to go. But our call this morning, our pitch is on DUEF, and it's a name that a lot of U.S. investors might not know. This is duty free. So this is like the mother of all reopening plays. There are 2 tickers, DUFN-CH. This is a Swiss company, Swiss francs. The price there is 53.04. There is also a USADR, DFRYF. USA, and that's about 58.46. So let's just jump right into it. What is DUEF in a nutshell? So this is duty free in airports. That's the best way to put it. So 90% of the business is tied to business, or not tied to business, but tied to airports and airport sales. If you take a 10,000-foot view, find me any other brick and mortar retailer where you have a customer that's literally landlocked in the store for an hour, zero Amazon competition, and the company is a globally diversified monopolist in every market where it operates. And the simple answer is you can't find one. It doesn't exist. So you go to the next slide, you got to look at the elephant in the room. This is tied to the travel economy. No kidding. Current numbers look absolutely atrocious. 2020 sales, which are going to be reported on March 9th, are tracking down to be about down 75 to 80%. This company is going to lose about 23 per share Swiss francs in the 2020 year. So clearly anyone investing in DUEF today has to look through a lot of turmoil in these numbers as they exist right now. But there's a couple of underappreciated angles, and this is our next slide. One is that it only has about 10% of the global duty-free market, and we're seeing an accelerated trend whereby you've got your local governments who are putting airports in the hands of private operators who want to upscale the shopping experience into a luxury model. And second point is that 90% of these concessions, of these concessions, which are held by these little local mom and pops, are just hemorrhaging right now, and they can't handle it, and they're eager to buy out of their 20 to 30 year deal, which opens up a big opportunity for consolidation for duty free in order to bring that upscale as well. I keep saying upscale. This is a company that's going more luxury. The old duty-free experience is you're stuck in between flights and you go and you buy a bottle of cheap vodka and smokes and a piece of candy for your kids, and you hop on your plane and you go home and you're happy. Whereas now it's evolving into a boutique model whereby there are luxury good boutiques that are operated by the duty-free operators. So this is very much a story of the duty-free experience changing. Next point here, there are a couple of key strategic partners to grow the luxury portfolio. And this is what really struck our interest last year, late last year. You had Advent International, which has the best track record in private equity land as far as investing in companies and actually riding them in over a multi-year time period. And adding a whole lot of value. Just they bought about 11% of the company. Just a month later, a company did a deal with Alibaba to own another 10% of the company as a partner to accelerate growth in the Asia-Pac market, especially China, which is the mother lode of the luxury goods market globally. 40% of luxury goods spending comes from China, and that's where the growth is headed via the Alibaba partnership. Our sense that Advent wants to have a much bigger stake in this as the concessions come up for bid over the course of the reopening, as these small mom and pops want to get out. The balance sheet here is stretched because of lack of cash flow right now with DUEF. So that's where Advent is going to pony up, and they'll probably increase their stake as they fund acquiring more concessions, which is going to make the recovery earnings faster than people think. Next point here, this is a really strong acquisition target. This business is becoming increasingly luxury, the same way RH brought their business model upstream, took margins from 10 up to 25, and is now growing a global luxury portfolio. These guys are doing the same thing. About 15% of the business is luxury right now. That's going to about 25 to 30% over a tail duration, especially as you got these smaller boutiques that become a bigger part of the mix. It's worth noting another 32% of the portfolio is fragrances, which caters to an upscale customer. I'm telling you right now, both Kering and LVMH, who are both have intimated that they're going to be more acquisitive post-pandemic, this is right in their sweet spot. So I think you have a very strong chance of this being acquired before it reaches my tail value. Next point here, this is really important. There's a big cost cut angle. This is something US investors don't really appreciate. This is a company with 44% of its sales coming out of Europe. In Europe, you just can't lay people off. And this is a company that's been an acquisition story over time. They bought new concessions. They brought on a lot of people and a lot of infrastructure. You just can't lay people off in Europe. Well, now with COVID, most of the European Union has actually eased restrictions and have allowed companies to match their cost structure such that it actually matches their revenue base. So they're cutting 400 million Swiss francs out of the model. That's good for 400 to 500 basis points in margin. That's notable in that pre-pandemic, this was a 3 to 5% margin business. So aside from the outsized top line growth on the luxury front with higher gross margins, you're going to see margins double just because of the cost being pulled out of the business. I think it's going to, next slide here, I think it's going to emerge from the pandemic a lot stronger than it went in. First off, of these new concessions as the duty-free retail switches hands from these desperate players into more of an upscale model, which is the sweet spot for duty-free. Second, outsized growth in China led by the BABA partnership. It's mid-teens% of sales right now, China, and that's going up to about 30% over a tail duration, which is very, very bullish. By 2022, I think that the new normal is going to be 7 to 8% EBIT margins versus that 3 to 5 that Dufry has been putting in over the past 5 years. So if you flip over to the next slide, that gets us to $8 in earnings power by 2023. The street's at $6.56. We're closer to $12 a share by 2025. We've got to model this thing out over like a tail plus duration. This company also has, it's got debt. It's got about $4.5 billion in debt. By that 2023 point of our model, its cash balance is going to be at parity with its debt levels. So you have a big delevering story here as well. So when all is said and done, you get this company that's going to, revisit peak margins as a healthier company with the better organic growth profile, with growth in the luxury arena. As such, with historical peak gross margins coming back, I think you're going to get a historical peak multiple coming back. Give it 18 to 20 times EPS on an $8 number in 2023. That's 151 Swiss francs. That's about 3 times the current share price over a 2 to 3 year time period. Just lastly, I point you to this slide here, slide 10. It just shows you who follows this. This is covered entirely by European analysts. You get some leisure analysts who cover it, some luxury goods analysts who cover it. There's no retail analysts who cover it, even though it's a retailer, which is just completely bizarre. The buy rating ratio is the lowest it's been in a very long time. And actually, if you just, I'm sorry to flip you back a slide, but if you take a look at this company, the consensus earnings estimates are 656 in 2023, and they're going up to 689 by 2025 at a time when we're seeing the most powerful change to the duty-free business model that we've seen in generations. So I just think people are out to lunch on this one, and they've got the earnings power wrong. And you have a multi-year multi-bagger on this name.
Multi-year multi-bagger by McGough. That's we're out of time on that one, but that's great. I mean, anytime I look at a stock like this, I just pull back where it was pre-COVID and then at peak cycle. And at pre-COVID, $10 a share on the DU FRY kind. That's the ADR. That's currently at 5.5. And prior to that peak cycle, the thing was at 14. So it's a better company coming out of it. So that's a really interesting idea, Brian. And I'm sure people will be paying attention to that going forward. Thank you. All right, just jumping into second on the docket is Mr. Penney.
More multi-year multi-baggers.
MultiState Operators. Are you going to give me
MultiState Operators? We were going to be multi-baggers. So obviously I want to talk about the cannabis space this morning. Keith, thank you for having me on. And I'm doing this in light of the fact that the cannabis, the MSOS was down almost 4% last week, and the stocks are taking a little bit of a correction. So I think it's a great time to focus on the space, and I'm going to focus on two names in a second, but I want to talk about sort of the catalyst for the industry, because that's really what's going to drive the stock prices. And I put it in 4 different categories: Washington, M&A, earnings season, and valuation, frankly. So we saw last week or 2 weeks ago, Senator Schumer come together with 3 other politicians to, move the deregulation or the descheduling of the drug in Washington forward. And what we saw coming out of that, or frankly, what I realized coming out of that, is how there are 10 different industry groups focused on cannabis, and they're all not on the same page, frankly. So coming out of that meeting with Schumer, you saw a new group, the U.S. Cannabis Council, and literally it was formed, I think, hours after the meeting they had, and it's really to put the group on the same page, or all the industry groups on the same page, to get reform done properly. And so what I think you're going to see happen is they're going to come into 2 phases. So I think even this week, maybe beginning of next week, but certainly one thing we've been saying about the Biden's first 100 days is you will get some sort of reform in the first 100 days. So the first way is going to take on banking and tax-related issue, 280E, and access to banks. And that's going to be important when I get to the last part about valuation. But second is M&A. The industry's raised about $1.8 billion so far this year. That's a record, frankly. And there's this public-private arbitrage that's happening within the U.S. operators. So they can go in and buy private companies at anywhere from 4 to 7 times, with their stocks trading at anywhere from 18 to 25 times. So they can continue to layer on, and this will get into what I'm talking about for both TerrAscend and for Forefront. But so they can continue to expand through that public-private arbitrage as they grow the number of states and the number of stores and the organic growth. So the industry has a lot of money. TerrAscend was out there raising money as well. They actually attracted 4 different institutional investors in the latest round that they raised. They named one of them Wasatch, but they didn't name the other 3. And we posted something the other day to talk about all the number of different institutions that are coming into the space, but that is definitely growing. So you've got M&A, which is going to drive growth in the industry, and then earnings season. And this is why I wanted to focus on TerrAscend, because it was just actually a phenomenal quarter. So they reported 4Q net sales of $65 million. That was 28% sequential quarter-over-quarter growth and 152% year-over-year. And they kept the guidance essentially where it was, but they beat both on revenues and EBITDA across the board. But more importantly, their margins in 2020 have gone, or EBITDA margins in 2020 have gone from 24% to 40%, and they'll average this year closer to 45%, I think, when it's all said and done. So you've got a company that's growing its top line. Sorry, just let me see. Growing its top line 80% this year, 2021, and its EBITDA 160% this year. Plus, they've got cash on the balance sheet to be able to grow the number of states. And then this is the most important thing for both TerrAscend and I'm going to talk about Forefront in a second. Is New Jersey literally is going through the process as we speak of formalizing retail sales, rec sales for the state of New Jersey, of which TerrAscend as a big operation. So once that rec goes, you'll be able to, these numbers. So by the way, the 88%, 165% revenue and EBITDA growth for TerraSyn has no New Jersey rec sales in it. So it's only medical. So if depending on when New Jersey flips the switch and goes recreational, we could see significant upside to that. Forefront is a little different in the sense that it is a smaller operator. It's smaller, but it's turning the corner on profitability this year, which is really important. So they're going to see 130% revenue growth and nearly 800% EBITDA growth because they're going from a loss to profitability. So they're really turning the corner. And I think when they report, and this gets to the next big part about why you want to be buying these stocks today, and that's earnings season. As you saw from Terracin, the numbers are incredible. Every company, TrueLeaf, CureLeaf, Cresco, Columbia Care, AYR, they're all going to have phenomenal quarters, and we can track that via the state sales that come out every month. And this past week, the numbers in Florida for TrueLeaf were off the charts good. So I would imagine that not only did TrueLeaf had a great fourth quarter, but the first quarter is already off to just a tremendous start. So the earnings season is going to be that catalyst, and Terracin highlighted that. And then just lastly on Forefront, before I get to the valuation piece, and I'm going to end on that, Keith, probably in a little early. So Forefront has applied for a New Jersey license, and they haven't gotten it yet, but they haven't been rejected yet either. So I believe that we're getting through this process where the state is going through, the cannabis people within the state of New Jersey are going through getting the laws written to get the recreational sales done. And when they do that, there's some licenses that needed to be issued. And I believe Forefront is going to get a New Jersey license, or it's a call option for me, frankly, on them getting a New Jersey license. So if you think how important New Jersey is in the Northeast, it's going to be a huge state. And if they can get a license, and more importantly, get it organically and not have to spend tens of millions or hundreds of millions of dollars buying the license, they get it organically. It's just a huge call option. And why wouldn't you own it for that? Just frankly, for that. One, their financials are accelerating. They're going to have a great quarter. The next year is going to be a great business. And then you get this free call option that they get awarded a license in the state of New Jersey. So lastly, I just want to, the hot topic for the group, frankly, is this discrepancy in valuations for the Canadian companies and the US companies. And right now you've got the US companies on 2021 numbers, trading at 7 times sales and 27 times sales, 27 times EV/EBITDA. The Canadian companies on the same multiples are trading at 19 times sales and 126 times EV/EBITDA. So the US market is an $18 billion market sales this year, right? The Canadian market is $3 billion in sales. So it is 5 times the number, or going to be 5 times the number. And, the Canadian market, if including the illicit, it's about an $8 billion market. That's the size of California, frankly, in a few years. So you have a $50 billion market in the US for the US companies versus, call it a $5 billion total addressable market for the Canadians. Yet you have this massive valuation difference between the two groups. And I am going to attribute that. Plus, you've got a margin structure, lastly. You've got a margin structure where, as I talked about, Terracin's EBITDA margins are going to be 43% this year. The Canadians don't generate EBITDA for the most part. And the ones that do generate EBITDA comes from businesses that aren't in the cannabis industry. So you don't make money selling cannabis in Canada, frankly. That's the bottom line. So I am going to attribute, and this is my personal opinion, 100% of the difference between the multiples of the cannabis companies in Canada and the cannabis companies in the United States to the fact that US companies are traded on secondary exchanges, right? They've got 5-letter symbols, not 4-letter symbols. And then if we can get what I talked about in the beginning, some policy changes in Washington, get the banking / tax related issues driven through the House and the Senate here shortly in the first 100 days of the Biden administration, you are going to see, I think, a significant uplift in the multiples. One, because all these companies are going to uplift to the same exchanges that the Canadians are traded on. And so you can have, you'll have a bunch of institutions coming in, you'll have retail investors coming in. So there really is this massive discrepancy between the multiples of the Canadian companies and US companies, which I feel is just a huge opportunity. So, buying stocks, as you like to say, Keith, buy them when they're on red. So we got Washington, M&A, earnings season is upon us, and then we have this valuation discrepancy. So three key reasons why you want to be buying in red today.
Well, people are paying attention to you, man. This stock's up 10% now on the day. This book, by the way, I cited it this morning, The New Chardonnay, The Unlikely Story of How Marijuana Went Mainstream. Even has Katie Couric on the top. Look at that. Howard, thank you, my man. Moving these things, and Hedgeye Nation figuring these stocks out alone is going to certainly matter. And what I meant was the forefront up 10% now on the day. All right, thank you, Jay Van Sciver. Is your connection working, my man?
Well, hold on, I just need to start my generator here. Today we're going to pitch you Porsche SE, which is the holding company that has shares of VW. So we're going to talk about VW. And I think if we're just being honest, the reason why this trades at such an enormous discount is because it's confusing. But it's actually not that confusing. Porsche SE is a holding company that just happens to own shares of VW. Completely unrelated for all practical purposes is that Porsche is a brand produced by VW. So if you can accept the fact, if it weren't called Porsche SE, if it were just called VW Share Holding Company, it would be a lot clearer as to what the structure is. But the weird thing about Porsche is that the shares it trades in the public market at about a 30% discount to the value of VW shares that it owns because of legal liabilities. And that's actually more of a discount than the total potential exposure estimated for those legal liabilities. So it's a weird anomaly in the market. And Porsche SE is a unusually good way to buy shares of VW because it trades at this discount. And you're probably going to see some of those liabilities go away through the year. And VW itself, like on slide 20, has made spectacularly good investments. Maybe it's better to be lucky than smart, but they own a third of QuantumScape, which is the solid state battery company that is probably one of the best recognized outperforming SPACs of late. It owns 90% of Traton, which is publicly traded. It owns a third of Argo AI, which is one of the most advanced autonomous companies. It owns Rimac, which is going to make really cool looking cars. What else do you need? It owns a lot of great assets. And these are also, when we think about narratives, like narratives that have emerged in this market, I can talk about it being cheap all I want, but these are the areas of the market, like self-driving cars, fancy batteries, all these things are some of the most narrative-driven, momentum-driven areas of the market. And it's amazing that when you go through and you add up all these parts for VW, you find that VW is trading for about half what it should be trading at. If you do all your comps and all that kind of stuff, it's in this, momentum-driven, narrative-driven area. And I can buy those shares at a 30% discount through Porsche SE, which may well go away at some point and just distribute those shares. Also, from like a macro perspective, you can see on the next slide that in general, in quad 1 and quad 2, and quad 2 in particular, autos tend to do pretty well. Like, when you come out of a pandemic, people mostly are probably going to be more likely to buy a car. And what's interesting is on slide 22, you can see that people have fled from public transit. Public transit is underfunded. It's facing a lot of problems. Even in the stimulus bill, you're kind of filling in past losses, not necessarily expanding networks. So I think you have some impairment of public transit infrastructure. And even now, people are still driving 10, 15% less, depending on where you look, than they were before the pandemic. So you're still in a weak consumption environment. And you weren't, in slide 23, our process is to look for old fleets, right? So we want to find that nobody's bought a backhoe. So, hey, everybody's got to go buy a backhoe because backhoes last 7 or 8 years. In the case of cars are living longer. They're better made than they were 10, 15 years ago, but they're also aging. We're not in a situation where people are overbuying cars. And, that means that, you do have this gradual below cyclical normal consumption that, because in cyclicals where you really get clipped is when you're buying something that's cyclically inflated and then, it looks like it's cheap, it's at a low multiple, but then suddenly, everybody lets the fleet age or whatever it is, and you end up in a cyclical trough. That's where people get hurt. So mostly we see them from our process being an old fleet where there's probably some pent-up demand from the pandemic and from an aging fleet. But the cool thing about VW, because of Dieselgate, because they got prosecuted and had to settle for doing the wrong thing, is they invested a lot in what is today, oddly, a very sexy area of the market, right? Electric vehicles. By probably the end of this year, I think at the end of this year, they'll be the largest EV maker, at least on a run rate basis, moving solidly into leadership in 2025. And I mean, if Tesla's worth almost $1 trillion because it has that market share in EVs, I mean, wouldn't VW then catch up, right? And VW actually makes a lot of money. They make almost half of Tesla's revenue in net income. And the EV revolution, I think probably your most expensive content here is that survey on the right of 24. Consumers want EVs. You can have all the arguments you want about whether or not they're good for the planet or governments should subsidize them or not. The reality is they're kind of popular. People want them. And really, who are we to argue with that? In terms of valuation, you can see obviously VW is very cheap relative to a lot of these better loved competitors, particularly Tesla. And you can see that the discount on Porsche has been there for some time. And that's because of these legal liabilities. And there's I think a potentially very good series of catalysts over the summer. German law is a little weird. There's biasing the case. There's limits on what the company will tell you about it. But the reality is that if they settle some of these lawsuits, which go back to the short squeeze and some hedge funds that are basically angry about it still, if you start to see that go away, that holding company discount could go away, and it would be a great catalyst to get the stock to work. In terms of valuation, you can go through and put some of the parts together however you want. You're going to have a very hard time doing that on slide 26 here and not getting a stock that's remarkably cheap. I mean, because a lot of the stuff is either, priced through offerings from, private markets or publicly traded, like QuantumScape, Triton. We don't even have some of this smaller stuff on here, like Rimac, right? And you have great brands like Lamborghini, Porsche, VW, Audi. These are not minor brands. And they're, something like Electrify America is also in a, remarkably, just look at Blink, right? Which is a vastly inferior charging network. And Electrify America shortly will be as large as the supercharging network Tesla has. In terms of, the technological leadership, which is usually the pushback, they're like a dinosaur, company or whatever. On 27, you can see just the R&D comparison. Like, not only just do they spend half of Tesla's revenue in R&D, like just put that out there, which could be cut and greatly increase net income, right? But they also spend more as a percentage of sales, right? So not only, they simply spend more on R&D. There are some risks, associated with Porsche. It doesn't, all these spread trades, there's no reason that it can't actually get wider. Like if it trades at a 30% discount, why not 40? I think there's good reasons why it will go away we have catalysts for that, with court dates and whatnot. But that's always a risk. There are supply chain issues in automobiles right now with chips that could have an effect on first quarter, second quarter capacity and manufacturing. And there are all kinds of regulations that come down for autos. It's a heavily regulated industry. That's usually a good barrier to entry, right? It's very hard to enter. Like it'd be very hard to go out in your garage and start making cars, whereas you might write some code or an app, but it is, it also can make the industry more expensive. So the upshot on 29 is that, VW is trading at roughly half its valuation. A lot of that's publicly traded. A lot of that's privately marked in, sophisticated transactions. And these brands, you basically get a lot of the brands for free, if you want to think of it that way. Mm-hmm. And then you can buy that VW asset, which is already cheap, at a 30% discount through Porsche, with a variety of momentum-driven narratives that should help to close that gap. You get a pandemic recovery and a quad 2 backdrop, which is the kind of environment in which, how often do you really want to own like an auto OEM or even an airline like we did last time? Not very often. You want to own them when you're coming out of like a recession. Other than that, there's somebody else's trade. But right now, it's usually the kind of time where you generate some alpha with that. You have demographics. There's a lot to this thesis we didn't talk about, but like, millennials buying houses, like as a person who lived in a city and didn't have a car for a long time, you have a kid, you're like, oh my God, I need a car because look what I'm doing to these like rental cars or whatever. and reduced public transit, I think, is also going to be a prolonged impact on auto demand. And these EV names are just simply, whether it's electric, charging, electric cars themselves, some of these battery technologies. I mean, they have interest in and leadership interest in basically every category that is very, very sexy right now. So I think it's the kind of discount that the market isn't going to let sit around for that long. So that is our Porsche SE pitch.
I like it. And it's for those of you that subscribe to Industrials Pro, this isn't exactly, it's obviously not the first time Jay's mentioned this name, but this has been a great stock. And it's similar to Brian's Duty Free in that you get this massive cyclicality and depressed earnings where something is legitimately cheap and it's got positive momentum. This stock, by the way, the ADR on this one is POAHY, Porsche. All right, Steinbomber.
All right. Good morning.
That's Josh Steiner's nickname, by the way, for those of you that you cared.
So this morning we're going to pitch a name that I think most consumers are familiar with, Capital One, on the long side. And if we go to slide 32, there's really just a kind of a perfect storm of positive backdrops here. So to begin with, the macro setup is very compelling. We have a highly reflationary, very favorable Quad 2 backdrop. Obviously the monetary side is there. The fiscal side, which has been a huge component of Capital One's last 10 months, is looking unlikely to change in any meaningful way, with further progress being made on this $1.5, almost $2 trillion additional stimulus bill. And as we'll see here in a minute, the impact there is really that the credit performance this cycle has just been unlike any cycle we've ever seen. And now the company is in a position where they've put so much cash on the balance sheet that they are actually going to roll out a very large buyback. So we'll go through that. And from a valuation standpoint, actually, the stock is very cheap relative to the broader bank group. And also we'll touch briefly on our AI system here and its thoughts, so to speak, on Capital One. So if we go to slide 33, this is the setup here from a credit quality standpoint. So on the left, we have 30 plus delinquencies. This is monthly data. Company puts out the incremental monthly numbers on the 15th of every following month. So we've got delinquency trends year over year on the left, and then charge-off trends year over year on the right. So starting on the left, what you can see is that delinquency rates really began tumbling through sort of the summer, fall of last year, and really over the months of October, November, December, and here into January have been running at just an extraordinary level relative to where they've been the previous year. So just really unprecedented levels of unprecedentedly low levels of delinquency. And charge-offs follow delinquencies on a lag. So the way it works is once you are 30 days late on your credit card bill, the clock starts ticking. Once you get to 180 days, you are charged off. So 6 months between when you go delinquent and when you get charged off. So as you can see, the chart on the right lags the chart on the left. Now it's the chart on the right that ultimately determines what the company will do with its loan loss reserves. And so what we know is that for the first 2 quarters of this year, when the company reports in April and then again in July, the numbers are going to be extremely strong. And what's interesting about that is if we go to the next slide on 34, the street is actually modeling a massive increase in charge-offs for 21, going from basically $5 billion in 2020 to $8 billion in 2021, even though charge-offs are running at just a huge year-over-year rate of improvement. So, we think the expectations there are wrong. The other thing to think about is that it's not just the charge-offs, but also the reserve build. So these companies have taken large reserves, and because delinquencies are running as low as they are, and because charge-offs are going to be much lower, not only is the provision expense going to be lower because the charge-offs are lower, it's going to be lower because they're going to be releasing reserves. So we think there's a lot of upside to earnings here in the first quarter and the second quarter when the company reports in April and in July. The other side of the book outside of credit card is auto finance. So Capital One is also the largest subprime auto lender in the US. And one of the interesting dynamics in the auto finance business right now, if we go to slide 35, is that this sort of COVID-induced work from home dynamic has triggered just a massive demand for vehicles. So not just new cars, but used cars as well. And this is the Manheim Used Vehicle Value Index, comes out monthly. And actually more recently, they've started releasing it twice a month. And you can see that used car values have just exploded to the upside. Really, really interesting dynamic here, and not showing any signs of rolling over. So if you think about auto lending, you're lending against the customer's credit, but you're also lending against the collateral of the vehicle. So when you're lending against used car values that are up like this, the existing portfolio catches an enormous boost, right? If you were going to lose 10 or 20% on the car loan, well, the inflation and the value of the car over the last 12 months basically just made you whole. So that's a huge tailwind for Capital One as well. The other thing going on, if we go to the next slide, 36, is that the company announced just recently that they're going to buy back $7.5 billion worth of stock. So wow, that's a big buyback. And, you know, with an outstanding share count of 460 million shares at the price where it's at now, they could buy back just over 60 million of those 460 million shares. And they plan to do it pretty quickly. So if you look at the street for 2021, the street's consensus share count number is actually flat year over year at 464 million versus 459 last year. It's actually up a little. So we think there's a lot of room for the share count to come down a lot more quickly than what is being modeled in these consensus numbers. So not only is there potential for significant reserve release, which is going to drive higher net income, but then with a lower share count, you're likely to have much stronger earnings per share as well. From a macro standpoint, if we look at slide 37, Quad 2 and Quad 1 are generally the sweet spots for Capital One and broadly for companies like Capital One. We can see that from an average and median return standpoint, there's sort of a toss-up whether Quad 1 is better or Quad 2 is better. But the bottom line is they both fare very well in Quad 2, and they have historically outperformed the broader market in Quad 2 as well as Quad 1 environments. So, you know, the setup here looks really good from a macro standpoint. It looks really good from an earnings standpoint. And then finally, if we go to slide 38, our artificial intelligence machine learning system is currently putting Capital One in the 0.34 overperformance score range, which puts it in the 0.3 bin. So historically, when Capital One shares have been in that AI sort of regime, the forward 1 year return from the stock has been in the mid 20% range, so 25% on a forward 12-month basis. So we like the quad setup, we like the AI setup, the earnings setup is there. We've got more stimulus coming around the bend. So there's just a lot to like here about Capital One.
There's a lot of momentum in it too. I mean, people generally look at a stock like this and like, oh, I missed it. But, you know, on a day like today, it's up another 3% in a down market. You know, this thing keeps powering forward. If the company's racing with you in Quad 2 to buy back the stock, and that's a lot. I didn't know it was that much. That's a significant percentage of the float. So another good cyclical idea. Thank you, Mr. Steiner. Let's just jump into number 5 now. We're already at number 5. Time's flying here. By the way, all the names so far that have been pitched are generating significant alpha today. So again, it's a good thing. Tom, what do you got? I think you might be muted there, Tom. You take your thing off mute. I could pitch this stock. Let's see what I could start pitching here in healthcare. This is going to be ugly.
You got me?
This is the one sector that I got no gain, man, like zero.
Can you hear me fine now?
Yeah, I can hear you.
All right. So you got, yeah. I mean, you'd think you'd learn something after all the years we've been doing this. So Dario Health is a, you know, it's it's a funny thing how you learn how to do new things over time.
DRIO.
Yeah.
Yep.
And what these guys are is it's been reasonably left for dead for over an extended period of time. But what they do is they essentially provide a customer, a diabetic, which is their core customer, a little device that helps them essentially keep all the tools and kits to measure their blood sugar. It's not fancy at all, but what they have on the back end is, essentially an artificial intelligence plus coach back end that helps people keep on track. And one of the interesting things that pushed me over the edge on this, amongst a few other things, which we'll just go through, is we were talking to an endocrinologist last week, and we've been talking to, folks about reopen. We've been talking about, how this all plays out going forward. But one of the things that's been creeping up in a big investment theme lately has been sort of this coach, right? One of the primary uses of telemedicine going forward is going to be, you're going to have this data, you're going to have your app or your on-body, your remote patient monitoring device throwing off data. There's somebody on the other end watching, right? And they're communicating with you. And this endocrinologist was really impressed with how well her patients were doing with something like a Dario. She didn't have experience with this. She had been using Livongo, which is also kind of the point here, which is the company that Teladoc bought for a lot of money, and is sort of the key to the thesis there, at least in the longer term. But in terms of what Dario does is they're essentially a handheld device that goes in your pocket that has your lancet, your strips, and your meter, which collects your blood sugar measurement for diabetics. It's not super fancy, it's not high tech, but what does become interesting is that disease management piece, the part where they're helping you get measured more often, stay in target more often. It is a pretty small company. It's larger than it was 6, 9, 12 months ago. If you go to slide 42, this is just kind of the basics. We did an interview with Mr. Raphael about 2 weeks ago, and we also had Rick Anderson on, who's the CEO of the company Upright, which is another disease management type device that sort of helps you with your posture, but is also going to be used in physical therapy, et cetera. So the idea here is that we have this customer relationship either through their diabetes or through their musculoskeletal disease. And it's that relationship, and these devices are throwing off data, which then feed Dario's artificial intelligence operations in terms of how that software learns to interact with you and to help you manage your disease. This is one of these things where it's a great story if true, but I really only need it to be partially true and maybe even just a little bit true for the stock to work. One of the things about what's been going on, within this private market, et cetera, is that there's a few privately funded companies that when you look at what kind of valuations they're getting for very similar product sets and very similar technologies, makes Dario essentially look cheap, where it's trading right now at around 14 times EV to sales, which is way up from where it was. But in terms of the growth rate, in terms of the model, in terms of where we can drive upside, there's a significant path here. On slide 43, you'd see a little bit of this. So up from our field notes in the upper right-hand corner, what they've been talking about, which is kind of funny, but it's also kind of serious, is that they've been quoting their own pipeline, right? So pipeline is what it is, right? It's like I have a customer that my sales guy says he can probably close. They've committed verbally when we talk to them to closing upwards of 20% of this of their pipeline here in the next whatever bit. We have a model in terms of how we're looking at this thing, where the sell side consensus number is right around mid to high 40s, and we're right in the middle of that without really thinking about them closing any pipeline. So we really need to hear them, one or two announcements away, I think, from the stock to really even get going from where it's been. If you look at the multiples now, again, this thing was really left for dead on slide 44, where looking at the lower end of the EV to sales, like, yeah, these guys clearly aren't going to, aren't a going concern. But up here where they could raise some money, they bought Upright, which I'm a user. I decided to do my own due diligence and try it out. And, I don't know what my review is going to say, but it's an interesting product nonetheless. There's not a lot of short interest out there, so it's not like we're going to get a big squeeze me, please me thing going on with this name. But it is a name that I think is going to get some traction here, as I think they're talking to the sell side a little bit. They're going to get increased coverage. They're going to be at a conference here, I think, this week. I think this Wednesday they're going to be appearing. So in terms of the trafficking of the idea, the interest level, I think has nothing to do but go up from here. The way we're thinking about it is as a comp to actually just on the customer experience again. They in and of itself on the diabetes side, they have very, very strong customer relations. This is also a theme we've been trying to play pretty consistently within healthcare, which is this is a novel phenomenon, right? That people don't really think of their healthcare companies that they interact with as something that they like, right? These are usually these are usually unpleasant experiences. In the case of Dario, it's a fairly pleasant experience. They have these big TAM slides on slide 46. Again, I don't need any of this to really be 100% true. I just need it to be a little bit true for this stock to work. Because if you look at the app downloads here on slide 47, they've been slowly grinding away on the left-hand side with Dario. That's the diabetes management tool. They're up to about 64,000 lives. An upright on the right-hand side, on the cumulative side, you can see this Upright Go, which is basically a device that you wear, and if you slouch forward, it gives you a little vibration. So, hey, sit up straight, and that's apparently got some clinical data that's good for your health. What they're doing here is that I think where they've been unsuccessful in the past, and where they've had this, 2,000, 4,000 new members per month, they're making this transition to where the money is, which is really selling into a benefits administrator who's selling into a corporate. And they're calling it this, going to B2B from B2C. And again, $500 million sitting in this pipeline that the sales guys have told them that they can sell. I think, the management team here is pretty active in that. And, it's credible because they've hired some really quality people in terms of their history and capabilities that they're bringing on, the talent to actually make this a really credible narrative. But again, if they just get a bit of it, and they've talked to us about closing 20% of it, again, if they get even part of that, the numbers in 2022 are going to be significantly higher. So on the pro forma, we've sort of teased this out in terms of looking at users, how the penetration is, what the churn is, and revenue per. And we can get the story between Dario at 26 million and Upright at around 21 million, sort of in the mid 40s. If you look at what this is worth, and this is kind of where the interesting sort of interpretive element of this pitch goes, is on slide 50, you look at where Dario sits to Livongo, which got taken out at 48 times sales.
Wow.
Or Hinge, which is a recent private deal that closed at around 37 to 42 times. When we're looking at EV to sales or EV to member, it's really about the trajectory and the slope. So something like Pfizer was a little cheaper at 10 times, which is where essentially the base, I think, in terms of risk, or where Dario's coming from. Particularly if they can get the cross-selling opportunity, get a couple of providers to close. And then the AI and the technology piece, I think, is really credible. Again, as we've talked to providers, and they're saying, my patients who are using devices like this, not Dario necessarily, but Livongo specifically, where they're saying they're using this, and they're saying, my patient's more controlled. They're having a better experience. They have a sense that somebody cares. So there's an element of how you have this technology reaching out and interacting with the patient, but it also prompts a human being that they develop a relationship over time, and it essentially leverages that relationship to get the patient more control with their diabetes, actually have a better medical outcome. And oh, by the way, they report this net promoter score of really, really successfully. So what is this all worth? Again, if we think about that 2022 is where our bogey is, I don't think it's not credible to be in that sort of 48 to $57 million range. Again, if they close some percentage of that pipeline, it's going to be in that range. What's a reasonable multiple? Well, what are the comps? The comps are sort of, it's not unreasonable, I think, to think about this as a 20 to 25 times, at least in the near term, and as the estimates are climbing higher. So that's our pitch right here for Dario. Again, thinking about this as, what's its peer group, what's its opportunity? Both are expensive and big. And then is the technology real? Are we hearing positive things back from the community? And the answer to all those things are reasonably true. So again, I think we're taking a pretty low risk function here to make this thing, a really credible long that could double here. This isn't a Brian McGough special, but it is. I think double is still a pretty good bogey.
Ryan goes for the 3-baggers and multi-baggers, and you go for the doubles. That's fine. But I mean, at the end of the day, it's only got 8 million shares in the float. And what's really interesting about this, Tom, is the insider buying. It's infrequent, and I need to double check that this data is accurate. But it's infrequent that you get both the breadth and depth of insider buying in a company on the way up, and that's exactly what you see in this name in particular. So
yeah, and if you want to listen to the replay, when we talked to Rick and Erez a couple of weeks ago, I mean, listen, I didn't hammer him, I wasn't a jerk about it, but it wasn't like we had any skin in the game at the time. And they're telling a credible story, and we confirmed a lot of the data sets that we like to look at. And I think we have a pretty reasonably high probability of success here as long as we track the data and stay in front of what we're expecting, and that we keep seeing those things.
Yep, keep measuring and mapping that data. The process is the process. Very similar from macro to micro here at Hedgeye. All right, thank you. Appreciate that. Last guy, cleanup, Andrew Freedman.
Yeah, and here I am in the studio.
Nice.
So, I mean, I guess I should be pitching my other top idea, Spotify, today, but I'm not. I'm actually going to go a little bit against the grain here. I'm going to go with T-Mobile, which actually does not do well in Quad 2, but I think the fact that it has been underperforming is actually a positive thing, because it allows people to get involved at a better price for when we eventually leave Quad 2, and it's a more favorable regime where telecom broadly outperforms. But we'll go right into it on the key thesis points. So in terms of our process, T-Mobile fits the process perfectly, because what we're looking for is some consolidated markets and winners and losers within those markets. In the case of T-Mobile and the wireless industry, it's a very slow-growing industry. We're looking at about 2% unit growth, but T-Mobile is just crushing it and is poised to take a lot of market share away from Verizon and AT&T, especially in this next 5G cycle post the Sprint merger. And that really goes into our point number 2, where they have been investing very aggressively in this 5G network build-out. They like to talk about it being their layer cake with a good mix of low-band, mid-band, and high-band spectrum. It was a great move to buy Sprint. They got a ton of mid-band spectrum, which they're now implementing, which puts them about 12 to 18 months ahead of most of their peers, to the tune of about $10 billion a year. So I think that is really going to be the key here, as we'll go into the next couple of slides, just around T-Mobile's opportunity to just take significant market share going forward. On point 3, they did acquire, it was a long slog, but they did acquire Sprint. That merger closed last year. The churn rates of Sprint prior to the merger were about 2x out of T-Mobile. It's come down a lot, but we think there's a big opportunity to create synergy just by getting that churn rate down in a big way. And when we think about or when we measure and map the broader industry and look at just market share trends, T-Mobile is actually taking down over 100% of all new gross additions, right? So they are, absolutely the winners here, and we think that their kind of disruptor status is going to continue on. Again, it's going to be mostly network-driven, less promotional. And then in terms of our catalysts and how we're thinking about, what's going to really get this stock significantly higher, we think that they are going to exceed their synergy targets. So currently about $6 billion on the OpEx side. We're going to get updates to those synergy targets next month once the quiet period over this latest C-band auction lifts. And then also there's a deleveraging opportunity, which frankly we may, deleveraging is great, but we also may instead get buybacks. So I'll take either or. But you throw these things all together, we have a market share winner that we think has an opportunity to disrupt their larger competitors, Verizon and AT&T. On slide 3, this is just kind of an overview of the market and what T-Mobile looked like before the Sprint merger and after. So they're already benefiting from scale by coming to be the clear number 2 in U.S. postpaid phone subscribers. And we think in the next couple of years, especially if they hit their guidance targets, this is going to be, they're not too far away from number 1. And I think they're going to surpass Verizon, which is going to really help with them on the margin side as well. On slide 4, this is probably the most important slide in terms of understanding the major trends in telecom and T-Mobile specifically, is we are at the knee of adoption when it comes to 5G. It has been a slow rollout. It's been slower than 4G, but right now everyone's ramping fairly aggressively. T-Mobile is ahead of the curve, so we think that in this upcoming cycle, they're going to take a ton of shares. What has been holding things up is use cases, right? So the incremental tick up in speed that you get from 5G isn't as meaningful. There's not as many use cases today from a consumer perspective. We do think that changes. Just case in point, the first 5G iPhone just hit the market at the end of last year. Samsung was out a little bit before that, but we're still a long ways from everyone rushing out there and getting 5G. But the point here is that while we're maybe 2 or 3 years before we're kind of at 60, 70, 80% adoption, we're actually at the knee of adoption, and growth is going to accelerate here, which I think allows T-Mobile to take share, which is a very, very important point. In terms of just the shaping up the network speeds here, if we look at 5G, it's not all created equal. Verizon has a great marketing strategy, but really you need to strike the optimal mix of both coverage, density, and speed, which is why we think that T-Mobile's bottom-up 5G network with the mix of low, mid, and high band spectrum will allow them to do that. So T-Mobile's speeds will come up over time. Verizon has a lot of high band spectrum, but it doesn't have a lot of coverage, as you can see. So they get high speeds, but it doesn't matter because nobody can access it, right? And so once you have that optimal mix, we think that puts T-Mobile ahead in a really big way. Some of the data that we're tracking, Net Promoter Score, I think it's a very common industry tool, but it just speaks to what the employees at the firm and the consumers ultimately think of this company. And we can see that T-Mobile ranks very, very high relative to their telecom peers. We think that this is going to be an important metric to track because if this metric goes south, that's going to be a red flag to us. But if they continue to stay high, especially if that Sprint metric comes up as well, that's all going to be positive signs for our thesis. And as I mentioned before, in terms of the additional scale providing margin expansion opportunity on the next slide, you could just see where the delta is in terms of adjusted EBITDA services margins and what the benefit of scale can really do over the long term, assuming that they are successful in getting this large user base. And over time, ARPU will go up, margins will expand, and then they're basically closing the delta from Verizon. But in terms of thematically how we're playing this space is we want to be long the share gainers and short the share losers. We also want to be betting on that margin gap closing, right? So that's going to benefit T-Mobile. It's going to be bad for your high margin services provider like a Verizon, which is also going to have to spend a ton of money on spectrum. In terms of just the overall synergy targets, you can see it laid out here. We are going to get, as I mentioned at the beginning, updated targets in March. I think that's going to be a positive catalyst. They're going to hold an analyst day where they're going to give us more updated info. So I'm looking forward to that. And then finally, in terms of the valuation, how we're thinking about it, our bull case is we still think this can be $175 to $200 stock, so 50-60% upside, assuming a higher end of the services of the EV to EBITDA range, and our out-year estimate with some modest margin expansion. Again, they are the fastest growing in telecom, so we think that they should ultimately trade at a premium here. And what's not included in our estimates, which is still a wild card, is fixed wireless, which is basically everyone gets their broadband delivered to their home through their cable provider today. The potential for them to actually launch a fixed wireless solution where you're not getting it from your broadband provider, but instead from your mobile phone provider through 5G direct to the home. That could be an incremental product lift, ARPU lift, margin expansion opportunity. No one believes that it's going to happen today. I think there's a reason to be skeptical, but at the same time, that's an incremental opportunity that could hit us up down the road. That's it. T-Mobile.
Really good. All right. For those of you that don't know, when we look at things, we look at them from a multi-factor and multi-duration basis. So what Andrew just did was he pitched something on what we call the long-term tail, so 3 years or less. The trends are 3 months or more. A lot of our analysts were talking more so about the trend and that manifesting positively currently. But as Andrew pointed out, you got factor exposures going against you currently in quad 2 for T-Mobile. That's one of the main reasons why it's been underperforming or why it's down. It's got big cap. It's got no short interest effectively, and it's low beta, and it's in the wrong sector. So all those sector styles fully loaded, those are factors you should consider. But if you're a longer term investor and you want to buy it, around the tail support is where I have it right around 109. Over the long term, we come out of quad 2, and to Andrew's point, that thing goes from, let's say it goes from 109 to 175. That would be a heck of a long-term investment. So keep thinking across durations, keep thinking across factors, keep incorporating your macro process into your bottom-up stock ideas, sector styles, et cetera. And we'll see you next time on The Pitch.